Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Great. Hi, Ben. I'm very excited to have you here finally. It's been a long time since I saw you when you first moved to Shanghai. Why don't we start by you giving us a bit about your background and then what you do at CMR?
Sure. So I'm American, but I've been living in China now for the past 15 years. I originally came over to China with an economics background, thinking I was going to stay in the country for maybe a year or so just to work on the language, and that I would then do the typical career path that a lot of Americans take coming out of school, which is go back and do grad school. In my case, I've been thinking about international law. But the first year I spent in China, I was living up in Dalian, which is a sort of an up and coming city up in the northeast part of the country. While I was there, sort of talked my way into a job working as a news anchor for the local CCTV affiliate.
Really?
So I was having a fun time, and I realized that I wasn't really ready to leave China yet, and so I started looking around for opportunities to work in a startup and try my hand at starting a business. And I was introduced to a man who was just thinking about launching a consulting business in China, because 15 years ago, there wasn't really a lot of good high quality data available to companies if they were thinking about how they were going to plan their growth strategy. And so we originally got started with the company thinking that we would be doing sort of basic research reports, providing market research to multinationals or domestic firms that were trying to understand specific sectors of the economy. That's not at all what ended up happening. Instead, what became very clear was that companies, both large and small, really felt like they didn't have a good handle on how China was evolving as a country, how the economy was evolving, how the consumer was evolving, and they didn't really have a good way to tie lots of disparate pieces of information together to come up with a real execution strategy for how they were going to scale their business. And so we ended up being much more of a blend of market research and actual, what I would call strategy consulting, focused on understanding the consumer market. So we got very, very lucky. I think the first year working at the firm, our very first client was Apple. So we were able to get good clients. We were able to develop a pretty good reputation in the market for having better quality information than most other consulting firms had, and then being able to parse that into something that a company could really use in an actionable way. So I've been with that business ever since. I work as the managing director of the China Market Research Group. So essentially what I do is I oversee our strategy vertical and all of the projects that we do on behalf of clients across a pretty broad range of sectors. In terms of what we actually do, I'd say the business is probably 60% focused on brands. So that could be, like I said, an Apple, it could be a consumer electronics brand, it could be an apparel brand, it could be a restaurant chain. And typically what they're doing is they're either trying to enter the market for the first time, and they're trying to figure out, who should their customer be, what should their product be, what should their actual strategy be in terms of how they approach the market. Or we're doing work for more established businesses that have maybe had a 20, 30-year run in China, but they're dealing with a much different competitive landscape today than they might have been 5 years ago or 10 years ago. And so for them, it's all about how they make their business more efficient, how they respond to competition, how they respond to changes in market dynamics. So that's sort of the brand side of the business. And then we also do what I would call commercial due diligence on behalf of professional investors. So that could be hedge funds, it could be mutual funds, it could also be private equity and venture capital. And for those types of projects, what we're really trying to do is look at a particular industry or a particular company and really get into the weeds and understand, are there any fundamental problems with this business? Are there certain things that an investor would really wish to be aware of that maybe they can't find themselves? And then if they do end up making an investment, working closely with the management teams of those companies to help them execute a growth strategy for the business.
That's amazing. I think we're Wizards Institute is a community to learn smart investing, and in our view, probably yours as well. We can't ignore China and Asia as a massive part of any investor's portfolio. So I think your background and CMR's background is perfect to share with us. Before we dive into it, I'm just curious, what type of work did you do for Apple, your first client?
That was an education-focused project. So they had a big initiative to build out their education business, both hardware and software in China. And I think they had some success with that, but I think like a lot of other multinationals have found, is that China can be quite challenging in terms of developing long-term relationships with institutions, especially those that might have some tie to the government in one way or another. So I think if you look at Apple, they've been tremendously successful in China, but they're also a very good example of a foreign business that sort of constantly struggles in the market as well for a variety of reasons. They do an excellent job of building a brand. They make products that have nice hand feel, that look quite interesting to the consumer, but increasingly they have to deal with political issues. Certainly with the current trade war between the US and China has made it quite difficult for them, especially because the Trump administration has really put an emphasis on slowing down China's technology advancement. And that's had an impact in the mobile phone space and domestic players like Huawei that have trouble buying chips now. I think Apple has also struggled because frankly, domestic competition has gotten quite a bit stronger. I think, the stereotype of Chinese technology companies up until 2 or 3 years ago was it's okay, but it's cheap and it's not really going to last very long, or it's going to be missing some features. I think if you look again at the smartphone space now, in many cases, the domestic Chinese firms are actually offering a better product than the Koreans or the Americans are. So it's a very different market now than it was when they started.
Okay. By the way, although Ben is much more handsome, younger, we do share the same high school, and my daughter as well, Ia, who's a co-author of our book. And so in this honor, I am wearing our school colors and a school logo, Ben, for you.
I can always put an Exeter hat on if you want to.
if you like that, we'll do some advertising. Although I think the brand itself is already strong in China. So let's go up 30,000 feet, Ben. From your perch as partner, as founder of CMR, your clients are multinationals, brands, technology companies investing in China. You mentioned you also deal with a lot of funds, hedge funds, mutual funds investing in China. How are your clients, first of all, viewing China as an opportunity for investing at a high level, right? And I guess what are some best practices that you're seeing as how they approach China as an investment? Again, whether it's Apple investing in China education, or a brand going in, or a hedge fund PE fund, give us a high level view of the environment and what kind of thinking it is mixing in with the current geopolitical situation.
Sure. Okay, so I think first, if you start on the brand side, from an investment perspective, China is probably the must-win market right now, just because of its scale. Other than the US, there aren't any other single country markets that have the kind of market potential needed to really make an impactful difference on a company's bottom line. So therefore, if you are a multinational, you have to find a way to be successful in China over the long term. And I think the challenge that a lot of companies have if they're entering the market for the first time is there is this assumption that because China is a big market, if you set up shop here and start selling something, you're going to get enough customers because you've got 1.4 billion people you're selling to, and it's a big place. The reality, though, is that it's an extremely competitive market, and most companies, if they're selling consumer products, are really targeting what I would call the sort of middle class or upper middle class in China. So you're really talking about more like 300 to 500 million people that you might be targeting. And so you have to invest quite aggressively and for a fairly long period of time to actually be successful here. Otherwise, you'll get boxed out by very aggressive domestic competition who can tend to iterate a little bit more quickly for what the market wants. And so I think, when we look at our clients and the ones that are most successful, and you look at their investment strategies, especially vis-a-vis COVID and the trade war, I'd say the most successful ones have really kind of doubled down on investing in the market. So they're treating this as an opportunity. They're saying, well, if sales in Europe aren't very strong, if sales in the US aren't very strong, we need to be investing more, not less in China, because that's really the only place we're going to be seeing growth from. But also it's an opportunity to kind of get ahead of companies that maybe aren't taking that risk right now and aren't making those investments in the market. So I think if you look at what makes a successful investment plan or growth plan in China, I think one is you need to invest to empower the local team. And that's really important from a product development standpoint. I think too many companies are not developing products specifically for the China market. And I don't mean like sort of like fake China product development where it looks like old time China from 2000 years ago, that kind of thing. That's not what I'm talking about. I'm talking about really understanding what it is a modern Chinese consumer wants in their daily life, understanding how they spend their time, understanding what trends they're following, and then really executing off of that. I think too many companies right now still are relying only on their design teams back in their headquarters, and the local China teams don't really have the power to make final decisions. And so that's a problem. So I think, giving power to locals, I think also investing very heavily in the right kinds of marketing in China. So I think in China, because e-commerce is a much bigger part of how people shop, companies need to tilt their investment in marketing much more heavily towards the digital space than they would in the US. So I think in China right now, depending on whose numbers you believe, retail sales coming from online are probably 25 to 30% of all sales. So that's much more in the US, which up until COVID hit was probably at around 10%. So if you're not doing the right digital marketing and you're not willing to spend on that, you're not going to be able to capture the consumer. I think companies also are finding that they have to invest very heavily in the right platforms that allow them to scale their business. So again, looking at e-commerce, I think having the right presence on the right platforms. So in the US, if you're, say, Nike, for example, you're probably driving people to Nike.com and you're getting a lot of sales from your own website. In China, you can't really rely on that. You have to have a presence on Tmall or JD.com or both in order to be able to get enough consumers to actually see your products. So I think the operational investment strategies in terms of how you grow your retail footprint, in terms of how you grow your marketing, in terms of how you make product for the consumer are very different in China than they would be in many other markets. On the institutional investor side of things, I think, frankly speaking, China is a really tough market. I think one of the things that makes it tough is there is a lot of money floating around. There's a tremendous amount of private equity money that is looking for good investments in China. And that creates an environment where it's hard to find truly good companies that deserve the valuations they're getting. And so you see funds putting a lot of money into businesses that really maybe shouldn't be getting that capital, or they find a good business, but they have to overspend to grow that business because they have competitors that are investing in the same space that are maybe trying to win by outspending you. So I think it makes private equity actually quite challenging unless you can kind of get into the right sector or the right business at the right time. If you look at the top unicorn investments in China, I'd say something like 80% of them have taken funding either from Alibaba, Tencent, or Baidu, which are sort of like the big tech players in China, and they all have very deep pockets. So if you want to be sort of an independent investor in an independent technology company that doesn't have funding from one of those guys, it can be really tough to stay competitive.
Sure. That was great, Ben. A lot to unpack. Let me sort of follow up on particular brand, and in my view, as you said, potentially a third of sales in China are e-commerce. So brand and to me and tech are very much related, right? But so you mentioned China is a must-win because it's such a huge market for multinationals. That sentiment, whether it's a brand company or a technology company, right? Has that changed in the past 4 years?
I think,
I mean, obviously prior to Trump, it was very noisily get to China, right? But the past 4 years, have you seen that beyond marketing and keeping quiet, but the investment, what are you seeing from actual interest to get into China?
Yeah, so the question is, are brands still interested in making that investment into China? And I would say that broadly speaking, the answer is yes. I think it has created, though, a lot of operational issues for companies, especially if they're also doing sourcing from the China market. So it's really forced companies to rethink their supply chains and maybe accelerate plans that they already had in place. I think, before the trade war started, many companies were already saying, well, the cost of manufacturing in China is going up. And maybe we feel like there's too much risk here because too much of what we're doing is happening in China. So we'd like to diversify that a little bit, maybe move some of our manufacturing to Vietnam or somewhere else in Southeast Asia. So that trend was already happening, but I think with the trade war, it forced a lot of companies to maybe accelerate their plans by 4 or 5 years to sort of mitigate that risk, because I think a lot of people were worried that there was going to be a lot of retaliation from China to some of the policies that Trump was putting in place. And I think that over the long run, that diversification will continue to happen, but that investment in manufacturing or sourcing from China, frankly speaking, is never going to go away. And the reason why it won't is because China has a much better infrastructure built around manufacturing and cross-border trade. So we've had clients, for example, who manufactured in China for a long time and then made the decision to move to Vietnam or Indonesia because the cost of workers there was quite a bit cheaper. And so on paper, it looked like a better deal. Problem is, once they do that, they realize that the actual worker efficiency is much worse than it is in China, and it completely offsets any of the cost savings they had in a negative way. And so we've actually had companies that have decided to leave China and then have brought their manufacturing back, because even though manufacturing costs go up every year, it ends up being more efficient than what they can do anywhere else. Now, I think over the longer term, one of the results of the trade war and one of the results of technology as well is you're going to see more of an emphasis on just-in-time manufacturing for sort of high margin, high value products. So examples of that would be like a Nike or an Adidas that have manufacturing facilities in the US or in Germany very close to the customer, but they're only using that for semi-custom shoes, for example. It doesn't really represent what they're doing for 95% of their actual manufacturing base. So I think that was a long way of saying, I think the investing is going to continue. Most of the CEOs or C-level executives that we talk to have said, assuming we can get any kind of funding released from our boards or from the corporate structure, we're still going to keep investing in China. We have to, because it's such a big part of our business now that we can't back away too much. And it's still really realistically one of the few places that we see growth.
Yeah, great. What's CMR, your view and your client's view of this new administration and how that might impact the foreign investment or sentiment into China?
I think it's too soon to tell. I think that, the theory anyway is that things will be calmer. It would be hard for things to not be calmer than they've been. I'm not convinced that policies are going to change all that quickly. It's difficult to roll things back. And I'm also not convinced that the Democratic Party necessarily wants to, go easier on China. They might not be as direct or aggressive in pursuing certain goals as the Trump administration has been, but I don't think we're going to see a complete rollback to the way things were before. But it'll be interesting to see how that dialogue opens up over the next few months.
Okay. Ben, can you give us an example of, I guess, the last 5-7 years since I've been out of China for that amount of time, of the most successful case you've seen, whether it's your client or somebody else, of a foreign company wildly succeeding in China, and what did they do?
Foreign companies wildly succeeding in China.
And the brand side. I start with the brand.
First of all, I think China is tough. So finding true, wildly successful examples is definitely not easy. I think if you look at the tech space, it's almost impossible for a technology company that is a foreign tech company to be truly successful in China, because there is too much, for a long time there was too much red tape and too much bureaucratic pushback, because the government was highly invested in seeing homegrown champions become successful. And now I think the reality is, even if you're Facebook or Amazon or Google, you're now competing with companies like Alibaba or Tencent, which are very, very good at what they do and very fast at innovating. And so at this point, with tech anyway, I'd say it's hard to find a really good example. I think if you look on the brand side, it's a different story. I think companies can be extremely successful growing their business off of China if they have the right marketing message, if they have the right product. If you look in the apparel space, for example, I think Montclair would be a good one. So for people who don't know, they basically make very highly priced down jackets. That's sort of their core business. And they have absolutely killed it in China, because they've been able to build a brand around essentially a single SKU, like a single product that they can be known as being the best at. And that works in China because I think the average, call it millennial consumer now, or let's pick a test case. Like, you look at like the average 28-year-old woman who has a white collar job in a city like Shanghai, she now is probably more sophisticated and more well-traveled than her counterpart who is American and lives in New York. She's been to more countries. She's tried purchasing from more brands. She's very sort of, I think, self-assured now as a consumer. And so
Probably speak some English.
Yeah, absolutely.
Which is, yeah.
So, I mean, you're talking about this very worldly, affluent consumer base that have already gone through the process of buying their first LV bag or their first Gucci bag or whatever, and now they're really looking for a brand that kind of caters to who they see themselves being as an individual. And so brands that can play in that high-end space and play off of having real brand heritage and interesting kind of funky design can do really, really well right now. And so I think Montclair has done a really good job of that with some of the seasonal product drops that they've done, and with very beautiful visual merchandising with their stores. So I think that would be one really good example. But I think you can look across the luxury sector as a whole, and you see several different companies that have done quite well doing that. But I think really, honestly, the times of foreign brands being the big winners in China are kind of, I don't want to say over, but I think it's a much harder road now. If I look at the most exciting brands in China over the last few years, it's probably been domestic players.
Wow. So, I'm the CEO of a U.S. European brand. I come to you and Sean, I say, hey, make me wildly successful in China. That doesn't sound very encouraging, Ben.
Well, I think it's important to be realistic, because again, I think there's not, maybe hubris is the wrong word, but I think a lot of these multinational companies still have this perception that the companies they're competing with in China are a bunch of peasants and don't know what's going on. But the reality is, if you look at where the innovation in China is happening now, it's kind of switched around, and a lot of the innovation is coming from the domestic firms. So if you look again at the apparel space and you look at, say, streetwear, for example, I think Li Ning is a really good example of a Chinese brand that has been hugely successful. So for people who don't know, Li Ning is sort of like, they're analogous to the Nike of China, but they were always a little bit cheaper. The design was always a little bit kind of copycat to what Nike or Adidas were doing in a given season. They expanded really quickly off this idea that they offered good value for money. And they kind of hit a wall, because consumers in China got wealthier and said, well, if I want to buy Nike, I'm just going to buy Nike. I'm not going to buy like the Li Ning ripoff. And so the company actually almost completely fell apart. They took private equity money and kind of rebuilt over the last 2 or 3 years. And they now have the Li Ning China streetwear brand, which is one of their sub-brands. And the whole brand is phenomenal from a design standpoint, because they incorporate elements of Chinese culture into their design. So for example, they'll sell you a windbreaker that has patterns from Ming Dynasty porcelain, silk screened into the windbreaker. They have ancient Chinese poetry on the sides of their basketball shoes. And they're playing to a very strong sense of pride that I think Chinese people have right now in being Chinese. I think there's a very real sense that China has returned to its historical status as a global superpower, and that Western countries, Western businesses shouldn't look down on China anymore. And so it's given rise to these brands like Li Ning China that can kind of cater to that and can design products to taste. Doesn't mean that foreign brands don't have opportunities in China anymore. They absolutely do, but they have to be very authentic about what they do, and they have to show the Chinese consumer that they actually care about the consumer. They can't really be cynical and say, well, I'm just going to sell you the same stuff I sold in the US, but I'll sell it to you 6 months later. That kind of a strategy doesn't work anymore. If you want to be successful in China as a brand, you need to be designing for the market. You need to be listening to the consumer. You need to be launching products in China at the same time as you launch them in other markets. And you can't lie to the consumer about what your heritage is. I think a lot of people in China have been burned by sort of like, a fake French fashion brand that is, really, from somewhere else or started last year, or the quality isn't that good. And so they're doing their due diligence now. They want to see that you've got your store in the Galeries Lafayette in Paris. They want to see that you actually have credibility as a company. So I think for brands to be successful, they have to have a lot more engagement with the consumer than they've had in the past. But if they do those things well, if they do the right product design, if they actually listen to the consumer, if they try to find a place in the consumer's actual lifestyle, they can be very successful. I think that what you're going to see over the next 2 or 3 years is a huge, huge uptick, for example, in growth of international winter sports brands. Because of the Beijing Olympics in 2022, you have a lot of consumers now spending on experiences and spending on the brands that cater to those experiences. So that's where I think you're going to see the next wave of foreign brands probably be quite successful. It'll be companies like, say, Burton, for example, that kind of is a big player in the snowboard space. They should be, if they do things right, very successful in China over the next couple of years.
Sure. Great. If I can summarize, I agree with you. For multinationals, China is becoming, if not already, the largest market for most sectors. So from an investor standpoint, whether I'm a CEO of a brand or as a fund manager, I would want to bet on the growth of consumer class in China. But from what I hear from you is, at least from an investor standpoint, perhaps the smarter thing to do is not to get excited about XYZ US company that's made a big announcement or big bet on China, because there's a good chance that they'll fail. Right? History tells us that. And rather, instead of pick the Chinese ones, for example, in apparel and sports, maybe Li Ning instead, and pick the local winners that would benefit from the growth. Would that be an accurate summary of what I'm hearing from an investment perspective?
I think that's fair. I think regardless of the sector in China, I'd probably be looking at who are the top 2 or 3 emerging local players first, before I'd be getting too excited about the multinationals that are coming in and trying to win the space. I think that's fair. It doesn't mean that those foreign firms can't also be good investment targets, but I think one has to be looking very closely at what their actual on the ground strategy is.
Yeah, I just think shareholders of a stock, for example, that's foreign, often will, especially in the consumer space, will look at what they're doing in China, right? As you said, if they don't have a China strategy, China growth, then they're missing a huge piece of it. Again, from what I'm learning from you just now is that even if their story is strong, it's a minefield, because if you get it wrong, I guess case in point recently is NBA, right? The politics of it will create a corpse. And so again, from what I'm learning, I'm saying, listen, if I have $1 to invest, I would pick a local company if I wanted exposure to the Chinese consumer market as a safer bet.
Yeah, I mean, I think that's a fair way to summarize the reality. If you're looking at getting exposure to the Chinese consumer and getting exposure to sort of the emerging trends where you're going to see the big fast growth, you need to be looking at local companies. If you just want exposure in the sense that, you know, some percentage of revenues are coming from the China market, then it's fine. You can just keep investing in, you know, GE or whoever it is that, you know, does some China business, but that's not going to be indicative of whatever big groundswell trend is happening in a given year
Sure.
or 5-year period.
Okay, let's talk about tech. You know, I guess the two brands that come to mind, one is Apple. Obviously, I consider that tech, although it's not necessarily software or social media, which obviously is a closed market for foreign players. And more recently, Tesla. Do you see them as success cases? Why not? And what's your outlook on those brands' sustainable exposure in China?
So I think using Apple as the first case, I think that a strong case can be made that yes, they have been successful in China so far. You know, for a long time, their phones were still really the coveted smartphone to have. If you had the money to buy it, that was sort of the first choice. And that was true probably up until maybe 2 years ago or 3 years ago. It's just happened now with the pace of innovation and the number of you know, fast-growing domestic players in the space that halo effect that the brand has kind of been eroded to some extent, and that mantle has been taken on by other domestic players. So I think a lot of people now would choose a Huawei phone over an Apple phone, not because they want to buy a Chinese brand, but because they actually think that certain elements of the product are actually better. But I think Apple is still, broadly speaking, pretty successful in China. They just have to really think about how they continue to have products that are truly innovative that can't be replicated too quickly by domestic brands. I think it'll be interesting to see what happens with the M1 chips that they've been putting into their computers and whether or not that allows them to build more of a presence in the personal computing space in China. I'm not sure that's going to be enough to measurably shift their business in China, but that's the kind of thing they need to be doing. But they're also successful in a China context in the sense that they've shifted a tremendous amount of their R&D to China. They have a huge R&D center in Shanghai now. And so I think actually a lot of the global innovation that company is putting together now isn't necessarily only coming from Cupertino. It might also be coming from China. And so they're leveraging the fact that China has more STEM graduates, computer science graduates, engineers entering the workforce than the US does in a given year. And so there's a quite a big talent pool now in China that they can draw from as they think ahead. So it might not be success from a brand selling into China standpoint, but it might be success as a foreign company leveraging all of the advantages that China has to develop product that might be sold in the rest of the world. So I would still call them a success, but I think they're moving in a new direction. If you look at Tesla, they're actually in some ways similar to Apple. I think that initially they benefited from the sort of shiny new toy effect. They were kind of offering a luxury vehicle. It was the first luxury EV that really was practical and worked well, that had mass availability. And so that was quite attractive to a lot of consumers in big cities in China, especially in cities like Shanghai, where for a while the government had pretty good incentives for people to purchase electric vehicles. So for people who don't know, a license plate in Shanghai costs money to buy. You don't just get a license plate when you buy a car. You actually have to bid in a monthly auction to get the plate. And
how much is it now?
It's last time I checked, it was about 15,000 US, but it might be.
It hasn't got much, but
yeah, it might be more than that now. I honestly haven't checked in a while, but I mean, think about that. That's the price of an economy car almost all by itself. And so the government's going to give you the plate for free if you buy an electric vehicle. It provides a powerful incentive. So I think Tesla got a lot of buzz because of that. It's also gotten a lot of buzz because Elon Musk has been, I'd say, in some ways pretty pro-China. He shows up to events in China. He talks to leadership. He talks a big game about the development they're going to do in China. And so I think a lot of people respect him for that. When you ask a Chinese consumer who their favorite celebrity is, what's interesting about the China market is you don't just get singers and actors and sportsmen. You more often than not, you will get entrepreneurs. So they'll say Elon Musk, or they'll say Jack Ma, or they'll say somebody else who got famous because they built a big company. And so I think Elon Musk has a little bit of that kind of cult of personality around him as well. But then, if you look at their opportunities longer term, on the one hand, they've been able to build this factory in Shanghai. They've been able to be, I think, the first foreign automaker that was able to actually own the majority of their business in China. Up until this last year, if you were a foreign automaker operating in China, you had to be part of a joint venture. And I think 51% of that joint venture would have been owned by the domestic side of the joint venture. But Tesla, I think, was able to work things so that they maintain control of their business. That's kind of a big deal from an investor standpoint, because then, at least on the face of things, it makes it look like maybe there isn't going to be technology transfer to domestic players, or they're going to be able to maintain their dominant position longer. The reality, though, I think, is that China has keyed in on EVs as being one of the key economic development spaces for the country over the next 20 years. They see it as an opportunity to maybe leapfrog foreign automakers and kind of become the number one dominant player globally in a category. And so right now you have hundreds, if not thousands, of smaller Chinese EV brands selling mostly compact cars, mostly in like fifth-tier cities that nobody outside of China has ever heard of. But that market is growing quite quickly and is starting to consolidate. And so I think over the next 5 years, you're again going to have 3 or 4 or 5 really strong local champions that are going to be able to go toe to toe with a company like Tesla on the technology side of things, and may be able to beat them on the manufacturing side of things because they may have more experience doing manufacturing than Tesla actually does. So it's going to be a really interesting space to watch over the next few years.
Okay, so thank you. That was very insightful, Ben. So for Apple and Tesla, they play the cards right politically, it seems. They went local, R&D, customization. Tell me, in your view, Zuckerberg, another much more famous alum of ours, did quite a bit of song and dance, right? From making frequent trips, obviously having a wife of Chinese descent, learning Chinese, jogging the pollution in Beijing. I remember that.
Yeah.
Obviously, famously failed getting Facebook or any of his products into China. Jobs and particularly Cook did a great job in China, as you said, Musk. What's the difference? Why did Facebook fail, and then these two other companies seem to be doing okay?
So
what happened?
Yeah, I think the first thing to remember whenever somebody is thinking about the China market is you have to consider the government and what the government thinks and feels here. And you also have to understand that the relationship between the government and the average person here is very different than it is in the US. I think in the US, we have a much more sort of fractious relationship with the government. It's like, we vote for someone, we expect them to do what we say. Whereas in China, I think it's more of a sort of traditional kind of Confucian arrangement. It's almost like the government is your parent. And that tends to be kind of the way the relationship dynamic works. And so therefore, from the government's perspective, everything they do is about how China maintains stability and doesn't end up back in the Cultural Revolution where people don't have enough food to eat and are starving and things are bad. So I think a lot of people sort of ascribe these evil intentions almost to the Chinese government policy. And they say, well, it's not fair that they're boxing out foreign companies, or it's not fair that they do this or they do that. But from the government's perspective, what they're trying to do is make sure that China has a good platform to remain stable and to grow so that over time, as much of the population as possible are better off. I think that's honestly how they think about things. And that has a lot of implications for companies trying to do business in China. And so I think, going back to the question, Facebook struggled because Facebook at the end of the day makes their money off of control over customer data. So getting people to look at a page and look at a feed of information coming through, and then selling that information to advertisers, and sort of creating this network effect that they can make money off. The problem with that business model as it relates to China is that from the government perspective, they don't want people saying whatever crazy thing they want to say online without a degree of government oversight. Because again, they're worried about that stability issue. So if you're Facebook, in order to have access to the market, you basically have to say, well, okay, we agree that all of our data is going to be turned over to you in real time. We're going to be policing what is said on our platform. And this is something that American consumers and European consumers will never stand for. And it's also something that the tech firm doesn't necessarily want to do because it's basically creating a big backdoor into their pool of data. And so that's why they've struggled, because that's something that Facebook feels they can't really capitulate on. And it's something that the government is never going to say, well, okay, it's fine. Facebook, you have a free pass, you do whatever you want. So it makes it difficult for them to be in that space. Then there's another element for Facebook, which is, I think around the time that they were trying to make their big push into China, you had these big Chinese firms that were trying to get bigger and develop their own presence, and we're probably lobbying pretty heavily to the government to say, well, look, if you let Facebook in the door now, we won't be able to compete. So I think that's why Facebook has struggled. The reality is they still make a fair amount of money from China because they can still sell advertising space to companies that are in China, but maybe advertising outside of China to potential customers. So China is still an important market for them. It's just not one where they've got a billion people with Facebook accounts. And then if you look at Apple or you look at Tesla, it's different because they're mainly selling hardware. And so there's less of this issue around consumer data and what people are saying online. That doesn't come up as a big issue. It's more an issue of, are they seen as being the dominant player in a space where the government wants a domestic champion to be strong? But in Apple's case, there are enough strong players that are doing the same things that they're doing that the government doesn't feel the need to tell Apple they can't be here. I think where Apple has run into a little bit of trouble is, of course, they have an app store. They have their own ecosystem for selling apps. That's a big part of their revenue. And they have run into issues in the past where they'll list apps for sale that are not admissible in China and they have to pull them, or the app store gets paused. But again, it goes back to data sharing and if somebody's trying to find a workaround. So for example, Apple had VPN apps for sale, and for people who aren't accustomed to the Great Firewall, what they do is they effectively let you make your computer look like it's not in China, so you can go on Facebook or on one of these other sites. And so Apple's gotten in trouble in the past for hosting those apps and has had to pull them down. But they've been pretty responsive to government queries, and as a result, they still have a strong business. And then Tesla doesn't really have those same data privacy issues to deal with.
Gotcha. So that explains the data issue tied to stability and control. Also explains obviously Google, right? In your view, Ben, how much does protectionism play in how the Chinese government decides who gets to come in, right? In terms of giving the local companies a chance to incubate and get to a certain size, whether it's EV, whether it's phones or content plays.
Yeah, I mean, I think protectionism is definitely a big issue at play across both sectors where maybe domestic Chinese players aren't very strong yet, as well as sectors where there might be very large Chinese players, but where there's a lot of evolution in policy still happening. So if you look at, for example, the banking space, the largest banks in the world, if you look at like a top 10 list of largest banks, big Chinese banks would be on that list. But it's only been recently that it was possible for foreign banks to get a retail banking license to operate and offer some of their services in China. And there still are a lot of restrictions if you look at banking and insurance in terms of what foreign firms can do. And part of that is because China wants domestic players to be strong, but part of it is also because the economy, the country have evolved and developed so quickly over the past 30 years that rules and regulations for some of these industries just haven't had time to catch up. And so I think China is going through a process, certainly if you look at the financial services space, where it's constant evolution and the laws are changing every year. And so they're very measured in terms of how they open up the market, because they don't want to introduce new systemic risks. They don't really know what's going to happen. They're trying to be very careful, and that's true of what they do vis-a-vis domestic firms as well. So I think a good example of that would be, Alibaba used to be one company, and then it split to be Alibaba and Ant Financial. Ant Financial was just in the news recently because they had their big IPO blocked, and that's an example of a domestic firm that got too big too quickly. And I think the government didn't really know what to do with it. So they've sort of tried to slow them down, because they offer a range of financial services that just didn't exist in China 10 years ago. And government hasn't had time to put policies in place or write the laws to make sure that allowing them to operate freely doesn't introduce new problems. So I think part of it is protectionism and wanting to give domestic firms time to grow. Part of it, though, also is making sure that policy has time to catch up to the rapid pace of economic development as well.
Sure, sure. So I agree with you that data is a huge driver in how the Chinese government might or might not regulate you. In the case of Apple and Tesla, Ben, I've been a sort of a iOS fanboy, and now I've been a very, very vocal Musk Tesla fanboy for luckily they've been great investments. But yes, there are hardware companies, at least initially, but obviously Apple has been pushing strong move towards services, monetizing a lot of the data, right? And I see Tesla actually featured as a more of a service software business than, at least profitability, than just the hardware side of it. And between all my devices in iOS and driving my Tesla, I think these guys know more about me than myself. Okay. So do you see this as a threat longer term from a data standpoint? But obviously these are strategic. EV, for example, it's a massively strategic industry for any country, right? Do you see this impeding eventually, whether it's Apple or Tesla going forward in China?
Not necessarily. I think as long as they maintain a good working relationship with the Chinese government in terms of how they handle that data. So maybe that data has to sit on servers in China that the government does have access to if they need it. Then I don't think the government would necessarily shut them out. And further, I don't think the government is necessarily going to see either of those companies as a competitive threat to domestic firms, to the point that they would be blocked purely because they're too advanced technologically. And that's because if you look at what's happening in the domestic space, in terms of what's going on with machine learning or artificial intelligence, or whatever you want to call that sort of evolving technology space, I think the domestic firms are actually ahead. If I am having a conversation with like my mom about buying furniture, for example, I will get ads posted on my phone showing me couches, because the phone is listening to me and sending that data back to Tmall and telling them I'm interested in couches. So I think they're very advanced in what they're doing already domestically. And so I don't think they're afraid of anything that Tesla is going to do or anything that Apple's going to do. And part of that's because the ecosystem that Apple has in the US, where somebody owns the phone and the AirPods and the laptop and some Apple home devices, doesn't really exist in China. You've got so many other domestic players that are already quite strong. Like if I'm in China, I'm probably using Xiaomi for most of my home stuff, because they've done a good job of introducing, I'm still waiting for Apple's phone controlled air purifier, and they don't have one, but Xiaomi has one. And so in China, where I'm worried about air quality, I'm going to go with the domestic player. So it's going to be very difficult for them or for Tesla to, again, be faster to market with what the market wants in China than the domestic players are going to be. Where they can win is they can, position themselves as premium halo products and sort of be seen as sort of the top most expensive choice, but that's not the biggest part of the market. So I think they can be successful, but they're still in some sense going to be niche players compared to some of the mass market options that are out there.
Okay, great. So Ben, we got 10 minutes left. You're not a professional investor, but you're obviously a brilliant guy. And this is not an investment advice site, but just for purposes of conversation, I guess two questions on investing. For your own portfolio long term, whether it's retirement, for your kids or grandkids, how much are you or do you recommend, or some of the smartest guys you've seen, as an allocation to China? And then what sectors, and then what are a couple of ideas of stocks that we should consider to hold for the long term? So it's really three questions, not two questions.
This is a tough topic to give a straight answer to.
It is. But again, you're in a great perch, right? What are you seeing? It doesn't have to be the Cavender family office. It could just be, hey, XYZ investor, and he's brilliant. What are you seeing?
Sure. Okay. So, first of all, when I look at my own portfolio, I was raised as what I would call a Benjamin Graham, Warren Buffett value investor. And so I'm typically, for my own investments, I'm pretty controlled in terms of what I do. I have, a handful of index funds that have a pretty broad allocation of different sectors, different company types, different regions, and I don't think about it too much, other than to kind of reweight it every whatever it is. So it's pretty vanilla in terms of what I'm doing. In terms of how I play China, I have an unfair advantage in that I have information asymmetry because I'm doing a lot of research every day into specific sectors, into specific companies, and so I know things that even the average professional investor that will pay for consults doesn't necessarily know. The way I do that is it's actually not in publicly traded equity. So what I do is I identify key consumer-focused market segments that I know are growing very quickly, and then I find a brand that wants to sell into China, and I will buy inventory of their product and then resell it.
Okay.
Yes. And so
this is not CMR. This is not
CMR.
This is not CMR.
Yeah, so this is a side project. So I actually act essentially as a distributor or a wholesaler.
Okay, well that's a business. That's a business.
Yeah,
so, but
it's a business, but it's investing. I'm just not
Gotcha. I got
buying and selling stocks. If you want to talk about China investment strategy and how to get exposure to China, though, if you look at where there are opportunities to be successful, I think you need to be thinking about consumer evolution. That would be my recommendation. And what I mean by that is look at what's important to the consumer and how they're spending their time and how they're spending their money.
Okay.
And that leads to a few sectors. So one is there's been a big push into the health and wellness space.
Mm-hmm.
And so that could mean different kinds of investments. It could be how do you invest in the right brands that are making safe food products for your kids. It could be investing in gym chains or technology companies that are built around the idea of fitness and wellness. That could be meditation, could be healthy eating, could be whatever it is. It is also education. I think as China becomes more competitive for foreign businesses, it also becomes more competitive for the average Chinese person who wants to be upwardly mobile and be successful in their career and have opportunities. And so I think that you have a lot of spending coming from parents who are investing in programs for their kids. And you have a lot of working professionals as well who are investing in skill training. And so I think the education space is also a space that I would be looking very, very closely at as well, because there's still a lot of growth there. Finally, I'd be looking at experiential spending. So I mentioned before, the Beijing Olympics in 2022. I think what you're seeing right now in China is there's been a shift away from people wanting to buy more stuff for the sake of showing that they've got money, to instead buying experiences and buying things that fit their view of their lifestyle. So they're spending a lot of money, for example, on yes, travel, mostly domestically this year because of COVID, but also all the things that go along with that. So expensive photographic gear, expensive active products. So that could be activewear clothing, could be, $10,000 bicycle, could be things like that. And so I think looking at brands that are catering to a much more active experiential lifestyle are also going to do very well.
Great lineup there. Again, not investment advice, just two guys talking. What are a couple of stocks that you love that you would hold forever?
Hold forever in a China context is always tough because I honestly,
Okay.
the
Hold for retirement.
well, assuming I'm retiring in just a couple of years. Let's see.
How about 5-10 year view, Ben? Things that you think are, just a couple of names that you think are just rock solid.
Yeah. So even though they've been absolutely hammered because of U.S. sanctions, this would be a good time to be looking at Huawei. They're doing some really interesting work right now with 5G, not trying to build 5G networks in other countries necessarily, but 5G as it will be used for future of transportation. So for example, they're doing demo networks right now along stretches of highway in China, and the 5G is going to be used to run all of the autonomous vehicles on the highways. I think they're going to be extremely strong both as a consumer brand and as a new tech brand over the next 10, 20, 30 years. So I think they'd be a very strong bet to consider. I think that I personally, I really like Tencent as a company. I think they've done a good job, and that's like a pretty popular choice, right? This is not like an unheard of company, but they've done a really good job of transitioning from primarily a gaming company to being sort of an everything company to everybody, but doing it well. I think the fact that they have WeChat and that WeChat is so central to everybody's everyday lives in China makes them very powerful because it's quite easy for them to invest in a new business line and add it to their portfolio and generate a new revenue stream without having to do too much work because of the built-in user base they have, because of the data that they have. So I'd be looking at Tencent. I think if you look at, if you say, well, picking the right brands to invest in is tough, the other company I would look at probably would actually be ByteDance. So I know that, again, TikTok, there's been this discussion about them being blocked out of the US market, and Trump doesn't really like being made fun of on TikTok, and that's been going on for a while. But what's been missed in all of this is while that whole storm has been brewing in the US, they've been quietly building out e-commerce as part of their business in China. And I think what you're going to see over the next 5 years and sort of the future of retail is that it is going to be increasingly more based on personalities, streaming sales of products. And TikTok is probably the best positioned company to do that because everything they do is based on short video. And they also are quite a bit cheaper to work with than Alibaba is. So if you're a brand and you're looking to sell online in China, but maybe you're a smaller brand, TikTok starts becoming very appealing to you because you can reach a young consumer base and you don't have to spend as much money to do it. So I think they're going to see tremendous growth as they continue to build out their e-commerce capabilities.
I personally think those are great picks, Ben, with the sound reasoning. Our book is called 10 Commandments of Investing, and we've interviewed some amazing folks, Kathy Street from Capital Today, a lot of the value guys you mentioned, and consistently what we're hearing is this Commandment 7 is marathon winners. It's okay to find a known name, whether it's Tencent or Apple, as long as they're growing 20-30% a year, which they are, and the winners don't go away. Exceptional companies will keep compounding, and magic compounding over 5-10 years, that's a lot of money to be made without having to obviously invest in a unknown startup. But the insight at Huawei is great. The insight at ByteDance is great. Thank you for that. Yeah. Any parting words of advice on investing in general and or in China?
I think, in investing in general, I think people should be thinking about investing for the long term. I think this idea that you can be day trading or making a lot of individual plays and individual companies it's quite difficult to pull off well and be successful over a long period of time, and you'll sort of drive yourself crazy doing it. So I think especially for somebody just starting out, it does make sense still to understand value investing principles, to understand diversification, and kind of take a more measured approach to things. The challenge in China, of course, is that it's harder for some of those sound investing principles that a lot of people grew up with to actually go into play, because if you're looking at listed companies in China, the markets in China do not always move in ways that immediately make sense, because there is a lot of government intervention, with the government going to various state-owned funds or partially state-owned funds that they have relationships with, and sort of essentially ordering them to buy a stock or sell a stock. You just don't quite know what's going to happen on a daily basis. So if somebody's thinking about day trading in China, or buying the whole index in China, or whatever it is, it's not actually very easy to do. I think actually the appropriate approach for China is you either have information that is special that allows you to invest in one specific company, or you look at the companies that are sort of nexuses of power. And that's kind of why I mentioned Tencent, or I mentioned Huawei, or you can make a case for Alibaba, because so much of the innovation in the economy that is happening right now in China, one way or another, flows through these 3 or 4 or 5 companies. They end up being the ones that also really benefit over the long term. So rather than trying to find some random tiny company that you think is going to be really hot, or going crazy, buying stocks that are on like the Chinext platform in Shenzhen or something, it may actually be better to stick to the bigger players, because they're going to be, generally speaking, safer long-term bets.
Yeah, great. Hey, so Ben, it's been fantastic. We learned why China's market cannot and should not be ignored, but also why it is so difficult to succeed, especially for foreign companies. We learned why the Facebooks and Googles of the world didn't succeed as they wish, but yet an Apple and Tesla are doing quite well and potentially can continue to do well, at least in your view. You gave us your sectors that you think are great long-term bets: healthcare, experiential education, and then some 3 very, I think, insightful stock picks. So to wrap this up, Ben, what do you care about? What does CMR care about? How do we find you?
I mean, we care about helping as many companies as we can sort of continue with their journey in China. We've got a website which I can send you after, if you can link it into the podcast. But we are pretty active in the press. If you search for my name, you're probably going to find me talking about something somewhere in Wall Street Journal or FT or wherever it might be, or you'll find one of my colleagues. So we try to share as much information as we can with the world as we sort of see things happening. But if anybody happens to need help with research or help with strategy, or just wants to chat, definitely feel free to reach out, and we'll do what we can to help.
Okay, fantastic. We'll put that link in our podcast, Ben. Thank you so much for your sharing.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.